Here in Canada, we have three main types of accounts geared for long-term investing: a registered retirement savings plan, or RRSP, a tax-free savings account, or TFSA, and a non-registered account. If we think back to our road trip scenario, accounts represent the vehicles we can use to work towards a goal. They each come with different features, making each of them more or less optimal for different scenarios. Over a lifetime, choosing the right account and optimizing that account can easily result in a difference of hundreds of thousands of dollars for a typical Canadian over choosing the wrong or unoptimized account. Even though this is really important to understand, this can easily confuse a lot of Canadians. In this lesson, we're going to compare the three accounts, highlight their similarities and differences, and discuss what each account is generally best for. When we contribute to an RRSP, our contribution offsets our earned income. If we're paying taxes on each paycheck we earn, this puts us in a position of expecting a tax return. Here's a simplified example. Let's say for every $1,000 we earn, we automatically pay 25% or $250 in taxes on each paycheck, resulting in a take-home pay of $750. If we then contribute that entire amount to an RRSP, we would reduce our taxable income by $750 and get 25% or $187.50 back when we file our taxes. Because we get the tax back on our contributions, the amount that we put into an RRSP is considered to be before tax. If Benjamin Franklin was right when he wrote, "In this world, nothing can be said to be certain except death and taxes," we know that the CRA will always get their money, and they instead tax withdrawals as income in the future. When we contribute to a TFSA, we don't get a tax refund in the present, but we don't pay taxes in the future. We pay taxes on it now instead of later. A TFSA could grow to $1 million and we could withdraw it all and not pay a cent of tax. A non-registered account will be most similar to a TFSA. When we contribute to them, we don't receive a tax refund in the present, but unlike a TFSA, non-registered accounts are taxed moving forward. In the future, RRSPs are taxed as income. TFSAs aren't taxed at all, and non-registered accounts are generally treated as capital gains, a tax-preferred way which is typically less than income, but more than not at all. Each year, your RRSP contribution room increases by 18% of your earned income, up to a set limit for each year. Your TFSA contribution room depends on when you turned 18, with an annual increase in room set by the government each year. For your RRSP and your TFSA, unused contribution room carries forward. If you'll be 34 or older at the end of 2025 and you've never contributed to a TFSA, you could have $102,000 of contribution room. And finally, there are no limits for contributing to a non-registered account. You could start contributing to an RRSP as soon as you have earned income. For a TFSA, you need to be at least 18 years old to start contributing to one, and for a non-registered account, you need to be the age of majority, either 18 or 19 depending on your province, in order to open one. There isn't a maximum contribution age for either the TFSA or non-registered account, so you could continue to contribute to them and invest forever. With an RRSP, however, you can contribute to it until the end of the year that you turn 71, at which point the RRSP is converted into a Registered Retirement Income Fund, or RRIF, and you have to start withdrawing from it at least in accordance with the minimum withdrawal rates. When it comes to what you can invest through these accounts, this is where a lot of people get confused. In any of these accounts, your funds could not be invested at all, invested in low interest savings rate, or invested in stocks, bonds, GICs, mutual funds, or ETFs. Remember, the accounts are simply a vehicle. Saying that you bought RRSPs or you bought TFSAs doesn't actually make any sense. The investment options available to you will depend on where you open the accounts. A credit union will likely be limited to savings or GICs, whereas accounts through a financial planner or financial institution should have a variety of options. It's important to understand how your contributions are invested and ensure they are aligned with your goals. The biggest advantage of an RRSP and a TFSA is the fact that they grow tax-free. This allows us to have more money invested, which will allow us to accumulate more than we would have otherwise. For a non-registered account, the biggest advantage is that there are no contribution limits. Beyond that, contributing to an RRSP usually results in a larger tax refund, so it can provide some short-term financial relief. A TFSA provides a lot of flexibility because you don't have to worry about paying taxes on withdrawals. Non-registered account growth is taxed as capital gains rather than income, which does provide some advantages. And in down years, creating capital loss could be advantageous as well. Because of the tax on withdrawals, RRSPs are best suited for retirement. You wouldn't want to use this for an emergency fund. TFSAs are also great for retirement, but can be suitable for a number of other goals. Remember, the more growth you get, the more advantage you get, so they really shine for long-term goals like retirement, but a less aggressively invested TFSA for a medium or short-term goal can also provide benefits. Non-registered accounts can be viewed as kind of an overflow account. Generally, it's best to max out your TFSA and evaluate your RRSP situation, but your contribution room can quickly dry up, making a non-registered account a nice way to continue investing. If you've come into a large amount of money, for example through an inheritance, selling a business, winning a lottery, or if you simply make a lot more than you spend, using a non-registered account is likely to come in handy. In summary, the main differences between the three accounts are when they are taxed and how they are taxed. But regardless of what account we use, we see some overlapping similarities. All accounts can be used for a variety of goals, but all shine the longer we invest for. The more growth we get, the bigger the advantage we get. Because of this, we want to make sure that what we use is invested properly and not just sitting idle. We also want to make sure that we have a plan in place to get the most out of them. For example, with an RRSP, a nice perk is getting the tax we paid back. Instead of immediately spending or wasting those funds, it's nice to reinvest them. Otherwise, it's kind of like we're paying taxes now and again in the future when we withdraw. Understanding how these accounts work, their pros and cons, similarities and differences, is really important because something as simple as what account we use can be the difference of hundreds of thousands of dollars over our lives, or after our lives. Another consideration is when someone passes away, their assets are liquidated and a final tax return needs to be filed. RSPs will still be taxed as income, non-registered accounts taxed as capital gains, and TFSAs can flow to beneficiaries tax-free. If your financial situation allows for flexibility and you want to pass on to the next generation, sheltering those funds from taxes in a TFSA could be a great way to ensure tax efficiency. Let's end this lesson by looking at an example. Let's say that after a long career, our friend Bob is ready to retire. He's only lived in Canada and throughout his career regularly contributed to CPP and a pension plan through his employer. He's expecting that his CPP, OAS, and pension will provide him with a before-tax income of $50,000 per year. In order to live his dream retirement, Bob would like to withdraw $100,000 before tax each and every year, so his pension and government benefits equal half of what he'd need. To fund the difference, Bob had regularly contributed to personal investments, but depending on what account type Bob used, his after-tax income would be significantly different. Here's his after-tax income if he earned $50,000 from his pension and government benefits and withdrew an additional $50,000 from an RSP, non-registered account, which resulted in capital gains, and a TFSA. If he used a TFSA rather than an RSP, his after-tax income would be over $16,300 higher. Of course, if Bob reinvested his returns, he might be able to withdraw more in retirement to find more of a balance. So it's an imperfect example, but it's to show the power that the different accounts have. Using an RSP might also result in a portion of Bob's OAS benefit being clawed back. Ideally, we want to try to balance taxes paid during our lives with taxes paid during retirement. For baby boomers who contributed to a pension and maxed out their RRSPs every year, they might find themselves paying more tax during their retirement than they did when they were working. For people who are earning a good income, living in Canada, in contributing to a pension or group RSP plan through their employer, it might be a signal that we'd want to consider using a TFSA to continue accumulating assets while saving ourselves from a giant tax bill during retirement. But the only way we can make that determination is by understanding our own financial situation and the accounts we have available to us.